Mortgage debt is a ticking time bomb, or prepare for the worst. Your mortgages are going through the roof. With headlines like that, I could not help myself but make a YouTube video because that's very clickbaity, very engaging. And I thought to myself, it's probably a good excuse for me to fire up my bootleg version of Excel from 2007 and walk you through some numbers and just explain to you what I feel is going to happen with mortgages, why I think it's going to happen, why this is not as big of a deal as it's made out to be. To me, it does feel like the mortgage renewal crisis is real, and I do think it will have an impact on people. The question is whether or not it's going to be a material impact, meaning will it change market sentiment over the next 6 to 12 months? If you're preparing to renew a mortgage in the next 12 months, this video is specifically for you. This is what you can do at renewal, and this is what you should expect. My name is Vas, and I'm a real estate broker right here in the city of Toronto, where I help families and investors navigate the complexities of our real estate market. I'm going to go over who I think is going to be most at risk in terms of mortgage holders, why you're at risk, and then what you can do about it. All right, let's get into the assumptions made in the model so that I can make this very clear for everybody of how I'm doing my analysis. So first of all, I'm assuming that everybody takes on a 5-year mortgage term. This is the most common mortgage term. Second of all, what are the functions that are going to drive your renewal risk at the time of renewal? Well, it's going to be the amount of debt you're carrying, regular debt. It's going to be the amount of mortgage debt you're carrying, which is really a function of when you bought your house. So for that reason, I'm going to focus on 2 specific years. So people that bought in 2014 and people who bought in 2019. We're looking at other people that bought in the years in between is not very relevant to me because they're not going to be renewing within the next 12 months. I am most interested to see who is renewing in the next 12 months and what the impact to them is going to be, because I feel they're going to be the most at risk. And the reason for that is interest rates are going to be high for the next 12 months with absolute certainty. I'm pretty sure they're going to be as high, maybe even higher, maybe a little bit lower, but for the most part, substantially higher from when these people originally got their mortgages. So with that said, let's take a look at somebody that bought in 2014. The average house price at the time was $566,000, and then somebody that bought in 2019 paid on average $819,000. I've made the basic assumption that if you bought for $566,000, you put 20% down and you have a $453,000 mortgage. If you bought in 2019, 20% down, you have a $655,000 mortgage. I know that's not the case for everybody, but we're just averaging it out. We're just trying to come up with some sort of a relevant number to put through this case study to see what's going to happen. Now, obviously, people that bought in 2020, 2021, 2022, we're not going to talk about them going to be renewing for the next 12 months. And what's going to happen 12 months from now, I mean, nobody knows. I mean, rates are still probably going to be high, but we don't want to speculate, and I don't want to get into it because I simply don't know. I just want to focus on the immediate short term, which is the next 12 months. If you bought in 2014 and your mortgage is $453,000, let's say 2.5%, give or take, 25-year amortization, your payment was roughly $2,000. During the 10-year period that you had this mortgage, assuming you didn't make prepayments, you didn't add on a HELOC or anything like that, the $453,000 that you started with, by the end of the 10 years, which is coming up for renewal now, so it would be sometime in late 2023 or early 2024, you're going to have $304,000 left on your mortgage that you're going to be renewing. So to recap, when you started your mortgage and for the last 10 years with relatively low rates between 2 and 3%, you were paying $2,000. Now, when you renew your mortgage at $304,000 at 6.59%, which actually, just to note here, this happens to be the 2-year fixed available right now, give or take 6.59. The reason I'm using this is you can get a 5-year fixed at 5.8 right now, but I don't think anybody is going to be locking up a 5-year fixed at 5.8% right now. To me, it doesn't seem like it would make sense. I would rather lock up for a shorter term at a higher rate than lock up for 5 years at 5.8. But that's just me. Don't listen to me. I mean, that's just my personal opinion. What is the point here? Let's say you renewed a 2-year fixed at 6.59 for $304,000, which is your current mortgage left over. You're looking at 31% increase to your mortgage payment. You're going up to $2,700 per month. So this is a pretty decent increase to your household expenditure. However, I don't think $600 to $700 per month are gonna, bankrupt people or force people to sell their homes. Now, here's a couple of things that I can tell you about mortgage renewals, at least just from my point of view. Again, I'm not a mortgage expert, and I will refer you to one that I usually ask all my questions to. Generally, if you don't want to requalify, so meaning to requalify for your mortgage, you have to do proof of income and everything else. If your work situation changed and you don't want to requalify, your mortgage will automatically renew with your lender. You just have to, I believe you do have the choice to pick between if you want to stay fixed, variable, Length of term is also available to you, and you do not have to requalify. Now, obviously, check with your lender. This is my experience. If you find yourself in a cash flow crunch position where the $700 is an issue, I do believe that certain lenders will give financial hardship solutions. So that solution is just extending your amortization. So let's say in this case, this person just finished 10 years of a 25-year amortization. So they have 15 years left on their mortgage. And as you will see right here on this middle one, that's what I've put here. I've put 15 years left, and this is what their payment is at 15 years. If you can prove financial hardship, I believe lenders will give you an extra 5 years of amortizations without asking you to requalify. So basically, you can go from 15 back to 20, which is obviously extending your payment terms, but it's giving you some breathing room on the cash flow where you're looking at $2,200 or $2,300 per month. Would I do this? Obviously, if you don't have to do this, don't do it. Just stick to the payment schedule and try to pay off your mortgage. But if you need the cash flow breathing room, that this is one solution for you. The last solution, the one I definitely don't recommend, is having to requalify and then re-amortize your entire mortgage amount over 30 years. And to me, that is a really bad idea, but I understand if you don't want to sell your house, you want to stay in it, and you want to make the payments as low as possible, that's the way to do it. But the negative impact of re-amortizing to 30 years is significantly higher than just the extra couple $100 you're going to be paying now to just stick with a shorter amortization. But again, you make your own decisions. I'm just here to show you what's up. We just spoke about somebody that bought 10 years ago. Again, I don't feel that they're at risk, couple $100 here and there. I think most households can figure that out. Here's who is at risk. So remember on my chart, I showed people that bought in 2019. Well, if you bought in 2019 with 20% down, your mortgage would have been, call it $655,000 right here. I put 2.5% mortgage rate. I think rates were a little bit higher. Maybe they were 3%. It doesn't matter. Let's just keep it simple and consistent with the last example. Your payment is likely about $3,000 per month. Now, also remember, mortgage interest is front loaded on the loan. So you're paying most of the interest up front, not at the tail end of the loan. So in this case, it's $655,000 mortgage. If you've made payments, you've kept everything consistent, no prepayments for 5 years, you would have paid off roughly $100,000 over that 5-year term, which is pretty solid at 2.5%. So your mortgage at renewal right now in 2023, 2024 will be $554,000. And here is where I see the problem start. So again, to recap, 25-year mortgage originated 4 or 5 years ago, $655,000. The payment was $3,000. Now you come up for renewal at 6.59. As I said, 2-year fixed. Your mortgage payment goes up 41% to roughly $4,100 or $4,200. With the 20-year amortization, as that's what's left on your amortization from the original inception of the mortgage. Now I think this is going to be an issue for household. This is a big jump in payments. I still feel that most households can carry that, but obviously there will be some sacrifices somewhere else in their budgets. Now, what can you do here? So let's say you deemed financial hardship or try to claim financial hardship with your institution, and you ask to get re-amortized back to 25 years instead of the 20 to drop your payments. So that brings you down to $3,700, which is still a pretty drastic increase from your original mortgage amount, but at least you don't have to requalify. Now, again, I think this is going to be okay for the most part. I feel these are the people that are most at risk. Now, relative to people renewing, I know there's an argument that can be made, well, the people that are most at risk are the ones with variable rate mortgages that took them on right before the pandemic started or during the pandemic. And that is true, but understand that those people are getting flushed through the system as we speak. I mean, there have been a number of sales that have happened since the middle of 2022 up until now, and they're still happening right now where people are selling at a loss. You see the examples all over the internet. So it's as unfortunate as it is, these people are going through the system right now as we speak. So we're seeing that happen. And as of right now, as of the recording of this video, which is July 14th, it has not impacted the market. So yes, the variable people are already being processed, if you will. But here's who's at risk next, which is most of these fixed term mortgages. Now, one more thing I'll add to this is that anecdotally, I know what ends up happening with people. If you have a lot of equity in your home, because it's very easy to build up equity here because prices have been going up 8 to 10% on average per year. Really, you don't have to be a genius. Buy a house and just sit on it for 5 years, and then boom, you have a couple $100,000 in equity through a HELOC that's now available to you. And the mistake, or not a mistake, but When you have that debt available to you at a low rate, people are like, you know what, well, I will add that pool, I will do this renovation, I will buy this car cash, I will go on these vacations. And racking up 100, 200, $300,000 of HELOC debt, while I'm not going to say it's super common, it's not uncommon either. Like, it happens. And at the low rates that we had, I can see why people were enticed to do it. And to me, that is probably going to be the biggest issue. I think these are the people that are going to be the most at risk, because combined with their mortgage going up, if you've tacked on this HELOC debt also that you're going to have to now mortgage and carry at a much higher rate, now you're going to have an issue. Hopefully not, but at least this is what I'm seeing from my end. So is mortgage debt a ticking time bomb? I mean, time will tell. To me, it personally doesn't feel like it's going to be, but I've been wrong many times before. What I will say is, you don't need every single Canadian to be struggling in order for mortgage debt to become an issue. It really will take 1 or 2% of homeowners to feel the pinch and have to list. And if that happens, that is enough to change the entire sentiment of the market. So it's a very delicate issue. I don't know how it's going to play out. I'm hopeful, obviously, that people don't have to sell their homes or lose their homes because of financial hardship. If you need a second opinion on your mortgage situation, you can speak to a pro. This is the guy I use right here, Sanj. Feel free to contact them and ask them any questions. I hope you found this video useful. And if you have any questions, you know where to reach me right here. And I'll see you in the next one. Thank you.